Question I get all the time. How much home can I afford? What is the purchase price of a home or condo based on what income I have today? This is a great question, and it's definitely one for your mortgage loan officer. But if you want to calculate that one off the back of a napkin, we've got you covered today. So my name's Amanda, and I'm a real estate investor as well as a mortgage loan officer, here to help you navigate what's going on so that you can plan for your next purchase. For debt to income ratios, today we want to focus on the back end debt to income ratio, which is looking at how much total expenses that you have compared to put that in a ratio with your total income before taxes per month. So how can we find this ratio out, and what kind of ratio are you looking for? Generally, you will need a 43% debt to income ratio or less, meaning you have less than 43% of your income is going towards debt payments. But sometimes you can go up to 50%. So let's calculate a 50% debt to income ratio for our example. The first number that you'll have to figure out is, what is your pre-tax monthly income? Pretty easy if you have a W-2 job. Just look at your pay stubs and figure that out. So for my example, we're going to say it is $5,000. If you are self-employed, take a look at your last two tax incomes and look at how much you claimed on your taxes for the previous year and the year before that, and average them together, divide by 12. That will become your new monthly income that we can start with. So let's see how much total debt payments you can have. If you want to go at a 50% debt to income ratio, let's multiply by 0.5 that income that we came up with. So in my example, 5,000 goes to 2,500. That means in order to qualify for a mortgage, all of my debt payments plus my new mortgage payment will need to be equal to or less than $2,500 a month. It keeps you having enough cushion for other life expenses that you'll have. So then what kind of things are included in the debt to income ratio expense side? So let's start first off with the things that you already have. This will be all sorts of car payments, student loans, credit card payments. So a really easy way to do this is to go onto your credit monitoring app, which could be Equifax, Experian, TransUnion, MyFICO.com, Credit Karma, Nerd Wallet, any of those. And add up each of those monthly payments. You pay $186 minimum on your credit card. You'll have a $300 car payment, etc. So for me, in my example, we're going to say that I'm paying $500 car payment. I'm paying $500 in student loans, and I have a $500 payment that I'm making to credit cards. So I have $1,500 in debt already. So that means that my mortgage payment and everything associated with that mortgage payment, which is principal, interest, taxes, and the PITIA, homeowners associations, will need to be under $1,000, because 1,500 plus 1,000 is 2,500, and that gets us to that 50% of my pre-tax take-home pay. Great. How can you figure out how much home you can afford? This is where you can go on to Redfin, Zillow, Realtor.com, and start looking at any properties and going ahead and entering in information that works for you. So you know how much you want to put down a down payment. That might be a specific number, or it might be a percentage of the loan. And you can know what the approximate interest rates are. And this will spit back out at you through our calculators what the monthly payments will look like. So you want to keep doing that until you find a level that gets you to about $1,000 in my example. And then you'll see what size mortgage is associated with your level of income. This is great for back off the envelope, but you definitely want to talk to a loan officer to really figure your things out. But the thing that's really important at looking at debt to income ratio is to understand how much control you do have in this situation. So now that we've learned a little bit about what DTI is, how to calculate it, you probably want to know, how can I make a difference in my DTI? Yes, you can. And I'm going to share that with you. So for instance, if you're able to get $100 more available for your loan amount, monthly payment, that's able to purchase you $15,000 more dollars in home at a 7% interest rate, which is the average what we're facing today, conservatively. So anytime that you can save through your DTI a little bit more money, allowing you to have more money towards your mortgage payment, you're able to afford more of a house. So that means that how can we start to save money? So one of the coolest things is you can start to pay off debt. How do you figure out which debt you want to pay off first? This is always a question that people have in their personal finances, and there can be different answers depending on what your goals are. So if your goal today is to say, I want to be able to afford a larger mortgage, then a great way to do that is to put all of your savings towards paying down loans that have a smaller amount until you can pay them off completely or pay them off until a certain number of months of payment left. Your mortgage lender can tell you how many months of payments you can have, and they can discount that from your DTI. For instance, let's say you have a car payment. If you get it down to 9 months of car payments remaining, you can completely wipe out that car payment from your DTI and don't have to use it to calculate your ratios. Check with your loan officer and figure out exactly what number of months those are that you can pay down some loans to either zero or to have a certain number of payments left and completely leave them from your DTI. Another tip is that you could reconsolidate some of your loans. You may or may not want to do this, but if you do, this is an option. So if you had a larger personal loan for $100,000 and now you only have $30,000 to pay off on it, this might be a good time to call up your lender and say, hey, could we refinance this, get those $30,000 and spread that out again over a longer period? And that could take your payments down drastically. And another thing that you should be very aware of is do not go getting any new loans at this time. Don't buy that car. Wait till after you get your house. Don't sign up and don't run up your credit card bill so that your monthly payment goes up or your credit score goes down. Try and keep things very stable during this time. Something else that you could do is to try to increase your income, but that can take a while, as usually you'll need to show income as being a source of income for 2 or more years before it's able to be counted. The faster way to do that, though, is to include a co-borrower. So this is a very big step, but if it makes sense for your family or your community that you're going to go in together on a home loan with all those responsibilities, this might be something that will help you to improve your DTI and to qualify for a larger loan. I think those are the biggest tips right now. And I really wish you the best of luck. And if you are ready to look for your new loan, definitely get in touch with me. We'll talk about all the different options that are out there for you and what you can do to get you the best deal. Again, this is Amanda Gant, loan officer, able to be connecting people with money all over the United States. And join us next time. Thank you.